Hey, Jason here. Today's video, I'm going to answer the question, is tech accessory stock Logitech stock ticker LOGI a buy? This is a stock analysis for Ocean, who requested this on YouTube. Before we get to that, though, I need to let you know you can get this video as a podcast anywhere in the world for free on all major podcasting platforms: Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this as part of the I Love Value Investing podcast anywhere in the world for free. And if you like this video here on YouTube and our other videos, make sure to subscribe and hit the notification bell so you're notified every time we release a new video. We're releasing videos all the time. Before I get to that, though, again, if you see my other videos, I apologize for this. I don't want to do this. I have to do this because every time I don't, I get nasty comments. This is for informational purposes only, to help you figure out, or to help you learn how to become a better investor faster, by showing you how to evaluate stocks better and faster. This, I do not short sell ever, so I do not benefit from any stock I talk negatively about. I also do not own any stock in a long position in any stock I talk positively about. This is done, again, specifically to help you become a better investor faster. Because these are for your requested videos, though, I often don't know what the company does. If that's the case, it's not today, and I'll get to that in a second. It's not today, but when that is the case, I purposely keep it that way because at this stage, I don't care about what the company does. I don't care what the story around the company is. I don't care what the CEO says that they're going to do in the future. And to transform the world, I don't care about any of that. At this stage, I need big profits, big fat cash flows, margin of safety on the balance sheet. I need undervaluation at this stage. If it doesn't have those things, then I don't even get to the stuff about story and all that, because that's, again, far down the road in my analysis. We're at stage 1 of my analysis in this video. Why should you listen to anything I have to say? Because in the first 9 years of my career, I've produced average annual investment returns of 23.5% per year on average in the portfolios I manage. This puts me just behind the great Warren Buffett when compared to the first 9 years of his career, where he produced 24.2% average annual investment returns at his Buffett Limited Partnership. My numbers legitimately make me one of the best stock pickers in the entire world over the last 9 years, but I'm not saying that to brag. I'm saying that to prove to you I actually know what I'm talking about a little bit. Okay, again, I apologize for that. Don't want to do that. Have to do that. Let's get to the analysis. Again, this is a stock analysis for Ocean. Thanks, as always, Ocean, for your great recommendations here. This is another one. We have a couple more coming up. We have stock ticker MED. I think it's MedFast. And we also have iRobot coming up as well in terms of analysis picks for you. Or analysis videos for you, not picks. Okay, paid dividend. They're a $16.1 billion company. I don't care about PE at all, but when I do, I want to see this under 20. So this is one sign the company might be overvalued slightly, but we'll get to that more later. Unlike most videos we do, I do know what Logitech does. I'm a lifelong gamer, and I know that this company makes a lot of peripherals, accessories, stuff like that, for gaming, cases, stuff like that. But for those of you who don't know what Logitech is, I'm going to read the description like I always do. Logitech International SA is a Switzerland-based provider of personal computer and mobile accessories for navigation, video communication, and collaboration, smart home, and other applications. Its product portfolio includes mice, keyboards, charging stands, tablet cases, car mounts for mobile devices, remotes, home cameras, home switches, controllers, Bluetooth speakers, surround sound, webcams, and conference cameras. It operates in a single segment, namely peripherals. The firm generates revenue from the Americas, EMEA, Europe, Middle East, and Africa, and the Asia-Pacific region. Pretty straightforward. Usually, again, I can tell a little bit about the company in terms of competitive advantages and stuff in the description. Can't see that here, so that's why you just kind of glossed over that. Okay, their revenue has skyrocketed from 2012 at 2.3 billion. This is in US dollars, 2.3 billion to 5.78 billion in the trailing 12-month period. That's not surprising because of the rise over this time of smartphones, tablets, gaming, all these things that are still exploding. So this is not a surprise, although the huge jump from 2020 to 2021 fiscal year is a bit surprising. That jump is from 2.98 billion to 5.3 billion in 2020 to 2021 fiscal years. I would assume there's some kind of acquisition there, because that big of a jump, yes, COVID is probably a part of that as well. But I wouldn't assume that would explain that much of a jump. So we need to figure out what's going on there. their operating margin has exploded as well because of that. I look for anything over 10% on a consistent basis. They've been at or near that every year since 2017. And that's gone up to 21.9% in the trailing 12-month period. Before 2017, that was below 7.3% operating profit margins. So they need it in the last 5 years. They don't in the 5 years prior to that. Is that a big deal? Not necessarily, because I care more about the recent trend than the past trend, especially in a fast-moving industry like gaming and tech. So this is not really a big deal. I would say this surpasses my threshold from 2017 on. Okay, they paid dividend. They've raised their dividend several times already. That's interesting from a small-ish tech company. They've bought back some shares. Again, interesting from a small-ish tech company. That's a good thing, but it's just interesting because usually you don't see that. They had 176 million shares in 2012. They have 172 million shares now, so it's down slightly. Not a massive deal, either negatively or positively, but is a good sign that they care about the shareholders of the company. Why is that? Because when shares go down, the companies are valued based over the long term, based on the cash flows and they produce and the assets they have. When the company buys back shares, that means it has, again, all else remaining equal, which never happens, but all else remaining equal, the company will or should have the same amount of cash flows spread out among fewer shares, meaning the price or the cash flows per share go up, which increases the per share value of the company, which increases the overall value of the company. So that's why buying back shares is such a good thing. It's optimal when the company is undervalued, though, which we'll find out shortly if they are. But this also affects book value per share as well. Book value per share isn't super important compared to what it used to be, but it still is a basic valuation of the company's underlying intrinsic value. Typically, you want to see this going up over time. When it is, that means the underlying, or it's one sign, the underlying intrinsic value of the company would be going up. We'll get to a caveat to that when we get to the balance sheet. But in this case, it's gone up from $7.33 per share in 2012 to $14.06 per share in the trailing 12-month period. That's an indication that the underlying intrinsic value of the company is going up over time. Okay, scroll down. Their returns on invested capital are spectacular. I look for anything above 10% on a consistent basis. They've been from 2017 on, they've been between 21 and 53%. So that's fantastic. They must, again, I'm seeing it here in the revenue and the operating profits, and now down here as well in the ROIC. Something must have happened between 2016 and 2017 to massively improve the company. I don't know what that was. I can't think of anything off the top of my head, even though I'm in this arena. I can't think of an acquisition. Maybe there was. I'm not sure. But maybe it was internal changes in the company. Maybe it was focusing on efficiencies. Maybe it was focusing on brand name. I don't know. But something between 2016 2017 happened to massively improve the company. And that is sustaining, because 52.88% returns on invested capital are spectacular. Again, I look for anything above 10% on a consistent basis. So that's fantastic. Free cash flow to sales, I look for anything above 5% on a consistent basis. Again, 2016 to 2017, massive improvement, almost a double improvement. But from 2017 on, their free cash flow to sales margins are between 9.6% and 26%. I look for anything above 5% on a consistent basis. So again, that's spectacular. They have a ton of cash on the balance sheet. That's good. That improves their margin of safety. Don't have any long-term debt according to this. They don't have short-term debt according to this. We'll get to if they actually do when we get to the balance sheet. But so far, they're looking fantastic. Cash conversion cycle is another excuse me, thing that looks fantastic. Typically, you want to see this number going down over time because it means the company is becoming more efficient over time. When a company becomes more efficient over time, it typically improves margins, cash flows, profits, revenues, all those things. And they've done that by selling stuff faster, by lowering the amount of inventory they have, and by also lowering the payables period. That is a good combination generally to improve the cash converter cycle and to improve the efficiency at the company. I have entire training videos on the cash converter cycle, so I'm not going to get into it in huge degree today. You can watch those for free at some of the links below, or search in the YouTube channel if you're on YouTube. But that is fantastic that their cash converter cycle is down from 35 days in 2012 to 27.9 days in the trailing 12-month period. Okay, so far they look like a fantastically run company. Okay, let's see if we can look at this. I could not yesterday for a company I was doing a live case study on. If you didn't see our live, that will be up soon, but I could not look at the balance sheet, quarterly balance sheet for that company. Okay, so they have about $1.5 billion in cash. Their market cap was about $16 billion, so that's fantastic. Inventories. So here's something to watch, not necessarily a major red flag, but it's something to watch. From quarter 1 2021, they had about $270 million in inventory. Now they have about $500 million more at $780 million in inventory with a non-equal rise in accounts and trade receivable. Why is that important? When inventory levels and accounts receivable should rise or fall at about the same rate. If they don't, this could lead to huge problems. How so? In this case, let's say, or their inventories are rising faster than their accounts receivable, meaning they have more inventory on hand. This could be a sign that they're having trouble selling more of their stuff in recent times. And that could lead to lower revenues, lower profits, and lower cash flows, because to sell stuff that is outdated or not selling well, they may have to discount it or just completely kind of throw it in the garbage. I'm not saying that's the case here, because I'm assuming this is a ramp up for the holiday season. I would assume that's what this is. I don't know what that is though. I don't follow it. Again, I know what Logitech is, but I'm not a close follower of their company. So I can't say that that's what that is. This also may be supply constraints, and they're trying to get a supply ahead of supply constraints, because the world is in short supply of pretty much everything. Again, that could be getting ahead of things like Christmas. I'm not sure. But if this continues and goes from, let's say it continues and goes to like 1.2, 1.5 billion, while accounts receivable does not go up, which it hasn't down here. It's gone up from 540 million in quarter 1 2021 to 620 million in quarter 1 2022. If this trend continues, that is not a good thing. That is something to watch. Again, at this point, I'm assuming it's a ramp up of sorts, but that is something to watch going forward. Other than that, their assets side of things looks very clean. Their liabilities are also very clean. They have little to no debt, ton of cash. They have a very, very, very clean balance sheet. Combine that with their fantastic and growing margins, profits, cash flows, all of that. Other things we just talked about. So far, this looks like a good potential investment, or a good company to at least consider doing further research on. But as I expected, actually they're not as overvalued as I expected, but they are overvalued. I'll get to that in a second. I don't care for PE, price to cash flow, or forward PE at all. But again, when I do, I want them to be under 20. PE is at 15.8. Price to cash flow is at 13.8. Forward PE is at 21.8. So in average, these are under 20. However, This number down here is the most important number. Enterprise value to Evit. Enterprise value to Evit is more important than the other numbers I just talked about, because enterprise value, the enterprise value part of this ratio, includes both the company's cash and the company's debt. Price, which is a part of the other calculation above, does not. That includes market cap only. And since 99% of all companies on earth have cash and or debt, I want to know what that is as a total business owner. That's how I think about the company before I think about investing. I also care more about operating profit than I do earnings, which goes into two of the numbers above. This, I look for anything below 8. This is at 11.8, rounded up. So it's probably about fairly valued right now, is what I would say. But with its gigantic margins, with its growing margins, frankly, with its huge margin of safety on its balance sheet, I'm not necessarily going to say this is a good investment now, because we need to do further research on it, but I am going to say we're going to do further research on it for the reasons that we talked about here. Let me bring back over here. So far, company looks undervalued, or decently valued, has huge margins of safety, growing margins, all that stuff. Ooh, thunder, hopefully you didn't hear that. What that means, usually when a company's kind of on the fence like this, for me, I make it a no. Why am I making it a yes here? If you've seen my other videos, you're probably wondering why I'm making this a yes here, that we're going to do further research on it. It's because it's about fairly valued based on that one relative valuation. We'll do more in the next video on Logitech. The biggest reason is their spectacular margins. This shows that they have some competitive advantages, or could have some competitive advantages. And when a company has competitive advantages and consistently great margins, you should value them at a higher multiple. So they might not be overvalued right now, which is what that one metric shows. We'll continue researching this in the next video, where we'll do the full preliminary analysis worksheet. We just did the visual part, stage 1 of my analysis criteria. We're going to stage 2 on this. We're now we've done this with several companies, or plan to do it with several companies. Perdocio Education is another one that I'm looking at. Turtle Beach is another one. Wide Point is another one. I think there might be another one. I'm searching through my notes over here. And I don't see another one as of now, but there are several we have done this, but we haven't done this very often. So we're going to do that next time. If I missed anything, if I didn't explain something well, if I should explain something better, let me know in the comments below. If you want me to look at a stock like this for you, let me know in the comments below. Every video for the last 3, 4, 5 months, and every video for at least the next month and a half is requested by a viewer. If you want me to request, or if you want to request a video, I would love to look at a stock anywhere in the world for you if it meets 3 criteria. It's not a bank, because I don't look at banks. It's not an insurance company, because you actually have to dig into the annual reports to evaluate them, and it has to be producing revenue. Why does it have to be producing revenue? Because I did some analysis videos on companies that did not produce revenue, and they were frankly quite boring. Because again, at this stage, like I said in the beginning, I don't care about the company's story. I don't care about what they say they're going to do. And if a company's not producing revenue, that's pretty much all that's going on. If it meets those 3 criteria, let me know in the comments below, and I'll look at that stock for you, put it on the calendar. I am now giving preference to masterclass students when they have requests, but I don't see any on the calendar as of yet to analyze. So if you want me to look at something and it meets those 3 criteria, let me know in the comments below, and I'll add it to the calendar. If you're looking for got ahead of myself. If you're watching this video on YouTube, thanks so much. Really appreciate it. Make sure to like, love, share, subscribe, comment, all that good stuff. If you do subscribe, make sure to hit the notification bell so you're notified every time I release a new video, and I release new videos all the time. If you're listening on the podcast, again, thanks so much. Really appreciate it. On the podcast, we'd really appreciate all that same stuff as well. But on the podcast, we'd like something special, and that would be a review, because the more reviews, views, and listeners we get on our content, the more people we can help. If you're looking for more specific help on how to become a better investor faster, make sure to check out our free resources below this, including our 5 free gifts, which you can get the full preliminary analysis checklist that we're going to do not next week, but next time on Logitech. And I've done it in a couple of videos. You can get that for free, the entire worksheet. You can get that as part of 5 free gifts. You can also get a free PDF copy of my book, How to Valuing Us. You can also get a free copy of our guide, 7 Tips to Picking Great Stocks and 3 Times You Must Sell. You can get all 3 of those for free at the links below. If you're looking for more specific help from me on how to become a better investor faster, make sure to check out our newly relaunched masterclass below, which you can find info on that below. We're getting new students in already. We're adding a ton of bonuses as of this recording, and these are going way fast. We've already got a couple students in. We've already got a couple students in talks to join, but the first 10 students that join will give a ton of bonuses to, including up to $9,000 in bonuses, which you can find out more info about at the link below. But until next time, have a great day. Talk soon. Bye.